Stock verdict is for informational and entertainment purposes only. Nothing in this video constitutes financial advice. Always do your own research before making any investment decisions. Not affiliated with Microsoft Corporation. Now, let's talk about the most expensive mediocre software company on the planet. Microsoft just reported $82.9 billion in a single quarter. Azure grew 40% year over year. AI revenue is now running at $37 billion, annualized. And the stock is somehow still trading below its all-time high. So why are some analysts quietly sweating? Court is in session. This is Stock Verdict. Quick note before we dive in. Nothing here is financial advice. I'm not your financial advisor. I'm just someone on the internet with a microphone and strong opinions about enterprise software pricing. Do your own homework. Now, let's get into it. Ticker, MSFT. Exchange, NASDAQ. Current price, around $450 a share. Market cap, approximately $3.3 trillion. Yes, trillion with a T. 3.3 of them. 52-week range between 351 and 551. Forward price-to-earnings ratio of roughly 24 times. 56 analysts cover this stock. Their average rating is strong buy. Average 12-month price target, $560. So Wall Street loves it, which, honestly, should make you at least a little suspicious. Let's start with the bull case, because there actually is one, and it's not bad. The AI monetization is real, and it's accelerating fast. $37 billion in annualized AI revenue, up 123% year over year. Azure grew 40% last quarter, beating what analysts expected. Over 80% of Fortune 500 companies are now using Azure AI services. Copilot seats are growing at over 160%. So yes, Copilot. The thing that auto-completes your emails with the confidence of someone who has never sent an email before. Turns out enterprises are paying for it anyway, by the hundreds of millions of seats. Because apparently, productivity theater is worth subscribing to at $30 a month per employee. Second, the valuation is actually reasonable for what this business is. A forward price to earnings of 24 times is below Microsoft's own 5-year average. It's cheaper than it's been at any point since the AI boom started in early 2023. For a company growing earnings at over 20% a year, that's not expensive. It's almost suspiciously cheap, like finding a designer jacket at a discount store and spending 10 minutes checking for hidden damage. Third, the balance sheet is genuinely exceptional. Operating margins above 46%, $625 billion in locked-in enterprise contracts, 24 consecutive years of dividend increases. This company prints money, the way your IT department prints unnecessary policy documents. Constantly, without stopping, whether anyone needs it or not. And fourth, Microsoft Build just happened this week. New AI agent capabilities, Copilot upgrades across every product, Windows AI features that make the operating system even more aggressively helpful in ways you didn't ask for. The product pipeline isn't slowing down. Whether the products are good is a separate conversation, but they're definitely being made. Now, here's the bear case. And honestly, it's the more interesting one. One word: CapEx. Microsoft has committed to spending $190 billion on AI infrastructure in 2026 alone. That's up 61% from last year. That's more than the GDP of some countries, and it's significantly higher than what Wall Street had modeled. Free cash flow is being squeezed. The payback period on that spending is years away, and it depends on Azure AI margins eventually reaching 40 to 50%, margins that Microsoft hasn't yet demonstrated at scale. So right now, they're essentially building a very expensive casino and promising the slot machines will pay out eventually. After the last earnings report, the stock initially sold off, even though revenue and earnings per share both beat expectations. The market is nervous, and the market isn't wrong to be nervous. When a company guides for $190 billion in spending and then says, Trust us, history doesn't always reward that confidence. There's also the cloud subscription problem. Azure isn't cheap. Microsoft 365 isn't cheap. Copilot is definitely not cheap. And it's not exactly winning awards for being indispensable either. Ask anyone who's used Copilot to summarize a Word document and received a hallucinated version of their own work back. Enterprise clients are sticky, yes, but sticky because switching costs are brutal, not because the product is beloved. There's a difference between a customer who loves you and a customer who can't afford to leave you. Microsoft has a lot of the second kind. And finally, competition isn't standing still. Amazon Web Services, Google Cloud, both are investing equally aggressively. Both are gaining ground in specific segments. Microsoft's lead in enterprise AI is real, but it's not permanent. $3 trillion moats have been crossed before. So, where does this leave us? The bull case is strong. The business is genuinely exceptional in a way that most companies aren't. AI revenue isn't a slide deck promise anymore. It's on the income statement, growing at triple digits. The valuation's the most attractive it's been in 3 years. 56 analysts cover this stock, and nearly all of them say buy it. But $190 billion in capital spending, with a payback period measured in years, is a real overhang. And Copilot being mediocre at $30 a month per seat is a real risk if enterprises start doing the math on whether the productivity gains justify the bill. For long-term investors who already own Microsoft, this is simple. You hold. The story's intact, the fundamentals are strong, the AI transition is happening, and Microsoft's in the middle of it, whether you like their UI decisions or not. For new money looking to enter today, the risk-reward is decent, but not screaming at you. The smarter move is to wait for Q4 earnings in late July. See whether Azure can sustain 40% growth while margins hold above 45%. If yes, the bull case accelerates, and you still get a reasonable entry. If no, the stock pulls back and you get a better price. Either way, you win by waiting 30 days. The verdict: hold. Strong company, reasonable price. Mediocre Copilot, outstanding cash flow. Real AI revenue, scary CapEx. Wait for the next earnings print before sizing up. That's the verdict. Court dismissed. If this was useful, subscribe. New verdicts every week. No hype, no hedging, no AI-generated email summaries of our own content. And remember, nothing here is financial advice. Do your own research, make your own decisions. Just maybe don't let Copilot make them for you. Stock verdict. See you next week.